Do you have a question relating to investing or finance that you can't find the answer to? Well, chances are I'm going to answer it today because I asked the subscribers of my newsletter to give me investing or finance related questions, and we got a lot of responses. Thank you for that. I'm going to go through them one by one today, and I'll timestamp all of the questions below so you can skip to sections if you want. I thought when we got this, I know what I'll do. I'll put them on coloured paper or card so it looks pretty, and just completely shanked it. So yeah, it looks like a hot mess, doesn't it? But the answers won't be. The answers will be informative. Before we start, I just need to say that the answers to these questions reflect my own personal opinion. They're not financial advice. In no way should they be taken as financial advice. I'm not a qualified financial advisor. And even if I was, I don't know your personal circumstances. If you want answers tailored to your own personal circumstances, then seek out the help of a qualified financial advisor. Let's go through these one by one, because that's what you do when you answer questions. Let's start with this top one. My current workplace pension is defined contribution. I pay 8% and my employer matches 10%. Should I pay extra into my pension or put the extra into an ISA? Are there any advantages to either? Okay, there's a few ways to look at this. Kobe, you'll have to believe that that went in the bin. It didn't go in the bin. So I'll give you an example based on my own personal circumstances because that'll help you maybe think about yours. I worked for an employer that only offered the basic requirements in terms of pension contributions. And when they paid into my pension, they didn't do it via salary sacrifice, which meant that if you pay into a pension via salary sacrifice, there's typically a national insurance saving, and some employers will pass that saving on to the employee. So that means then, if there is that sort of arrangement, making extra payments into your work-based scheme could be beneficial because you might also get that NI saving on top of it. Now, in terms of making payments into a pension, there's always a benefit there, the tax relief that you get. So your question, I believe, I've just screwed it up and launched it across the room, so I don't know for sure, was asking if you should just pay into an ISA instead. Don't forget that you can pay into a SIPP and get that tax relief benefit as well. But I think more this is a question around flexibility and choice. Most work-based schemes are either more expensive than you could do for yourself, or the fund choices and investment options are limited. The reason that we're part of the schemes is to get the benefit of the match contribution from the employer. If you max out that contribution and there is no additional benefit in terms of NI, for me personally, what I used to do was pay into a SIPP so that I could have more control over additional deposits above and beyond what my employer would match. I hope that answers the question. Next one, orange this time, how lovely. How do I move an old inactive default DC pension from a previous employer into a SIPP? This one couldn't be simpler. You just use a pension transfer process, and that's really easy to do. So if you log on to Vanguard as an example and you have a SIPP with them, they have a button where it says transfer a pension. You just click on it and follow the steps. All you'll need to make the transfer is the policy number, which you can get by logging on to the pension, the old one, and also the amount that you want to transfer. They'll ask you the balance of the pension. So basically log on, get those two bits of information, and then follow the internal process of any SIPP that you're with. Quick process, you're talking minutes. Okay, next. What is the best pension strategy for someone that is self-employed and no longer an employee of a larger firm? How much, how often, who with, what strategy, and what risk profile? Okay, let's do this for me because I'm self-employed. As much as I can afford, because the tax benefits are amazing. If I pay in through a limited company, say, I get to save on corporation tax, so it's, really attractive in that way. As much as I can afford, as often as possible. I tend to do it once a year, once I know how the dust has settled. But if you're the kind of person that bleeds your accounts dry every month, then maybe just stick it in all the time. I personally just buy a global index fund. It's the same approach I have with all my investments. I don't really want to think about it. So I just do that, for the long term. And the way I see it as a self-employed person is we tend to, believe in our businesses. Oh, one sec. Nothing but net. We tend to believe in our businesses and that they're going to deliver us exceptional wealth, but they might not. So the pension really is a plan B. The pension is the thing that captures you if your business doesn't pan out. And I think every single self-employed person should be building that safety net. All right, green. Is now a good time to consolidate various work pensions? They're on default options, and I think it's safe to assume none of the pensions will be 100% equities. But I'm not sure how that informs our decision to consolidate or wait. Okay, consolidate if you're comfortable doing so. So you think you know what you're doing and you know what you're going to do with those funds. Also, if you think it's going to save you fees or that you have, more investment choice and all of this sort of stuff, you're speculating there in terms of, I don't think it will be 100% equity. You should log on and check that point. And the main thing is you need to be careful that you don't lose any associated benefits with the pensions that you're in. It's worth calling the pension provider and saying, what benefits will I lose if I transfer out of this scheme? And the main thing is don't transfer out of your current scheme in terms of the one that your employer pays into, because if you do that, you might get kicked out of the scheme and then not get the benefits. You definitely don't want that to happen. Why do Hargreaves Lansdown charge me higher fees for investing in an index fund rather than an ETF? Are they not the same thing? They're not technically the same thing. They're very similar, but an ETF, an exchange traded fund, is traded live on the stock market like it was an individual company. So HL have this fee model that means that you pay dealing fees on that. I think the bigger question here is, why the hell are HL charging what they charge full stop? They're a bit of a rinse all the way around. They've recently been bought by a private equity firm as well. And my experience with private equity firms is they like to buy things to milk them for all they're worth. I can't really see the situation improving, but I might be surprised. They might, revamp it and make it cheaper and more competitive. I always hear the term reassuringly expensive with Hargreaves Lansdown. And I just think, looking at the market nowadays, they seem very pricey all the way around. Okay. Red. Financially speaking, is buying a house still a worthwhile investment? Buying your own home to live in and own outright, I think is 100% a worthwhile thing to do because it'll stop you paying rent when you're retired, which relieves the pressure on, your outgoings on a monthly basis. I think it should be the goal of everyone to own a home outright if they can for that very reason. From an investment perspective, I think long-term property will do great because I think inflation and a shortage of supply are two things that will push prices up long term. But I don't think that you can sit there and go, they're going to double every 9 years like they have done for the last, say, 40, 50 years. And, 10x and all of this kind of crazy stuff in London. I think those days might be behind us. There's this saying that kind of goes, what made the previous generation rich won't make us rich. And I think property is that thing. I think you're going to do well with any asset if you buy it at a good price and you hold it long term. But, so the answer, I guess, is yes, but with a long-term view. Okay, how should we teach children about finances? Should we give them pocket money? Should they know you're saving for their future? God, I really struggle with this one. So I've got a child of my own and my partner has a child and, I see them both as mine. And I'm not perfect at this. I don't know is the answer. I think we kind of get left in the wild with our kids, don't we? And we try and do our best. One thing that I have learned is you need to allow them to make mistakes in a controlled manner so that they don't make big ones when they're older. What I mean by that is give them pocket money, let them blow it all on stupid stuff, and then let them realise that they can't then buy other stuff later on that they want. I think that controlled kind of disappointment is good for later life, and budgeting. Don't come in and save them constantly when they run out of money, if you will. And then secondly, I have an investment portfolio for my son. So I have his junior SIPP and junior stocks and shares ISA that I put money into. But on my Trading 212 ISA, that's the main broker I use at the moment, they have like a pie function where you can set up pies and you can kind of separate them out from your portfolio. I've set up a little pie with him and he bought some companies that he thinks will do well. He'll be wrong. And then, no, he won't. He actually picked some good companies, to be fair. And then I made him buy a global index fund as a benchmark so he could see how he's doing versus the world. And he quite liked that idea of I'm trying to beat the world. I've told him he can't touch it for years, like 4 or 5 years. And I just want to kind of get him accustomed to seeing his money, because it's his money coming from his pocket money, go up and down and kind of get used to that emotion. And hopefully over that time period, he'll have done okay. So then he can, when he is 18, he'll know that the stock market is not this alien thing. It's something that he has done and can do. In terms of telling your children about the money that you're saving for them, I want to talk to my children about these things, but I do also worry that it will give them this kind of confidence or reassurance because, in my son's eyes, £1,000 is like an unimaginable amount of cash. He thinks if he's got a tenner, he's like the richest man on earth. So if I start talking to him about having thousands of pounds in a junior ISA, he's just going to be like, I'm a made man. I don't need to work. I don't need to do anything. I don't know the answers here. I think there's probably books that are much better at talking about this. What I'll do is I'll dig some out and I'll put them below for you so that you can have a read. Okay, next question. Damien, given that you're self-employed, are pensions worth it? Being tax efficient and generally getting the most out of being a sole trader? They are 100% worth it. Because, again, just to echo that sentiment from before, as someone who's self-employed, you're banking everything on your business. If you sell that business one day, amazing. But there will come a day where you can't work. And if you're a sole trader and you're like a builder, or you do something with your hands or whatever, what happens to the day where you can't do that anymore? What have you built? What can you exit? What money or value have you stored up to see you through your retirement? And I think a lot of self-employed people are kind of on this never of, I need to put all the money into my business. I'm going to grow the business. One day it's going to deliver this big payout or whatever. I think just having a pension is a plan B, and I think it's a smart plan B. It's very tax efficient, and it's something that can just sit in the background. And then no matter what happens, when you get to retirement, you've got that there. We should all do that, no matter what our employment status. Okay. I know you should just buy and hold, but sometimes I just need to sell. E.g., changing ISA providers or moving to a new fund. What's the best way to do these things with minimal risk? Changeovers are very nerve-wracking, and Sod's Law dictates the market will rise between the sell and buy. I guess my question to you is, why do you feel the need to sell? Why do you feel the need to change funds? I mean, maybe if it's like you picked the wrong fund and you want a new one, but you could always just buy the new fund and not sell the old one. Or if you have this kind of like, oh my God, the market might drop in the few minutes that it takes me, just do it gradually. Sell 10% of the fund and buy 10% of the other one and do it over time, and you won't notice the difference then. All right. What's the best ratio strategy of bonds, shares, and other investments when setting up a private pension that is not needed for another 10 years? So I'll quote Andrew Craig here, who is now a friend of mine, which is weird. He wrote How to Own the World, and now I got his WhatsApp. It's like mental to me. Anyway, he basically says 100 minus your age is the kind of the portfolio split that you should have. So, if you're 60, you'd be 40% equities, 60% bonds. That's kind of how he looks at it. I personally have a different approach to this. And what I'm going to do is I don't think I'll carry bonds. I don't like to say I won't, because I'm just a young whippersnapper. What do I know? I might get there and be like, oh God, load me up on the bonds. But my plan at this point, and this has been formed by speaking to lots of financial advisors on the podcast and other people, is to just have quite a large cash buffer. So 3 years of cash, and that is effectively a way of de-risking my portfolio. People tend to look at their portfolio as only what's in their stock basket or in their pension, but your portfolio is every asset that you own in your life, isn't it? It's all of the cash that you own. So by having 3 years worth of cash in high interest savings, I can effectively draw from that as my retirement. So I'll live off year one, and then I've got year two and year three in reserve. If the stock market's doing great, when I spend year one, year two moves to year one, year three moves to year two, I sell 4% of the portfolio value, and I use that to fill up the bucket at year three. It's this waterfall conveyor belt kind of system. If the stock market dips in a really bad way though, what I then do is I don't settle any of the equities. I just live off the 3 years worth of cash, and I wait it out until the market recovers. And I hope that within 3 years, the market has come back to life a bit. That's the way I'm going to approach it, and that's how I'll look to de-risk my portfolio, if you will. And what that means is I've still got a large exposure to equities that's not just some kind of like random number, so that I can continue to see growth into my old age, because my view is that I'm going to live well beyond 60, because, I need to believe that, otherwise what's the point? I'm not fucking leaving. Right. Is there a way to move from SIPPs to ISAs over time, and is that sensible? Well, a SIPP is a product that has a restricted age of exit. So you can only access it at a certain age. So, if you're under the age of 55, 57, whatever it is for you in particular, you can't access it. In later life, then maybe you might want to do that. But when you take money out of a SIPP, that's a taxable event. It might incur a tax bill depending on how much income you're taking, and you're taking it out of the protection of a tax wrapper to put it into another one. There could be circumstances where you would do that, but I'm not sure that that's something that, from the tone of the question, it comes across as you want to do that now before retirement. You wouldn't be able to do it. Okay. Looks like the S&P 500 has gone down recently. Is this a good time to buy given the price is lower? I mean, yes, I would say, it's always nice when there's a dip, especially if you're younger. You want crashes. Always in. You want crashes because they give you a better entry point. That's a good thing. They're not bad. But, zoom out 100 years and the S&P looks like that, right? Pretty much. So that means any time was a good time to buy over that time period. I think, try not to ask yourself too many questions about should I be buying, shouldn't I be buying, because that will lead to sometimes the answer being no. If you've got a long enough time horizon, 10 years plus, typically the answer is you should buy. How do I know? Oh, here's a good one to follow that up. How do you know when to sell a certain stock? So if it hits your target price, so you should have a target price. You've basically said, I bought this company because I think it's cheap. At this price, I don't think it's cheap anymore, or I think it's fair value, so I'm going to sell it. So if it hits that target price, if the thesis for why you bought it has changed, so if something's come out that has changed the main argument of why you're buying it, that happens. Revolutionary technology, competition, information you didn't already know. If you bought it by mistake, this happens a lot. People buy a company because of like a widespread narrative, like AI is the future or electric cars are about to take over. Both statements are true, but that doesn't mean that you should buy any electric car company. You might have gone, this was a mistake, I didn't know what I was doing. And then the fourth one, basically, if you think that there's another investment that would do better. So if you think, I might get 10% a year here, but I could get 50% a year here, then that's a reason to sell as well. Okay, next question. Which children's pension is the best to invest in? Fees seem crazy at first glance. So children's pension, a junior SIPP, great product. The greatest gift that you could give a child is to invest in their pension when they're young, because you can let compounding do the rest. And when they get to retirement age, hopefully you're still alive, but if not, they know that you were an absolute legend. Fees are high for these products across the board. I use Hargreaves Lansdown, but I've had a look around and Fidelity looks like it's got quite a good offering at the minute. I might make a video on this or put an article together with the newsletter and stuff so that we can look at it in a bit more detail. I couldn't know off the top of my head, but yeah, Hargreaves Lansdown, Fidelity, I think is coming out on top. But in the comments, let us know if you think that you found the one. Okay, what is the magic retirement number and how does an ordinary person work this out without a financial advisor? 46, that's the magic number. No, I joke. If you're asking me how much you'll need to retire, that number's personal to you, and a good place to start is 25 times whatever it costs you at the minute to live. Don't forget, though, that you are not going to be traveling to work and things like this, and hopefully you won't be paying off a house for a mortgage or paying for rent or whatever. But you are on a 7-day weekend, so there will be other costs that you need to factor in for. A good place to start would be the PLSAs, the Pension Lifetime Savings Association, I'm going to say. Their guidelines, and what they do is they break down, this is what a basic, moderate and good retirement looks like currently. So you can take those numbers and you can look at it and go, okay, that's the kind of life I want. And then what I would do is I'd run that through an inflation calculator. And all that does is adjust the value in today's money to when you retire. What that means then is you go, okay, if I wanted 35 grand now, but I adjusted that for 2 to 3% inflation for 30 years, I say that's 70K, whatever, I'm just pulling these numbers out of the air, times that number by 25, and that will give me my retirement target. That number's going to be scary because it's going to be a big number because you've adjusted it for inflation. But don't forget, investments and earnings and all those things over that timeline should have tracked along with inflation as well, there or thereabouts. But yeah, that's kind of how I would work it out. Okay, I'll leave links to all the things that I mentioned below for you. Next thing, what is a good yearly pension amount to aim for, keeping tax efficiency in mind? I think I just kind of answered that question, right? It depends on what you want. Obviously, the pension, let's look at the actual withdrawals from a pension then instead. They're taxable like their income, but you can draw down certain portions of it tax-free, and then you can use an ISA or other investments to prop up that income. So if you don't take your 25% tax-free lump sum at the age of 50 odd, I say 50 odd because it'll be different for different people watching, you can then draw that as income on a monthly basis, meaning you can get a large chunk tax-free. You get your tax-free allowance as well of like 12,500 odd, and then you can draw your basic rate of tax. But you could get that 25% lump sum tax-free, plus the 12,500 say, and then you could start drawing from ISAs, you could be taking 50, 60, 70K a year completely tax-free. So I think it's the structure of how all of your portfolio, and this is why I'm so keen on everyone building multiple pots inside of different vehicles so that they can have that tax efficiency later on in life. Okay. Next one. I've been a high rate taxpayer for a number of years and don't quite earn enough to need to do a self-assessment tax return. I've recently found out that the government have only been putting 20% into my pension fund rather than the full 40%. How exactly do I get HMRC to backdate my pension provisions if I can't do a tax return? You can do a tax return, so anyone can do a tax return. This is something that I bang on about quite a lot because it's free money that, well, it's not even free money, it's your money that people are leaving on the table. Certain pensions, workplace pensions, when you pay into them, you're not getting the full benefit in terms of the 40% tax relief if you're a higher rate taxpayer. This means that you need to fill out a self-assessment to claim that money back. Complete the self-assessment form or contact HMRC. You can backdate up to 4 years here. So the bad news is you're not going to get it back for all of the years. The good news is you're probably going to get quite a nice chunk for the last 4 years. And then every single year from now on, you can complete that self-assessment and claim the other 20% back. If you're a higher rate taxpayer, paying into an auto-enrollment scheme, or if you make payments into your pension and you're not completing a self-assessment, you're missing out on potentially the additional 20%. Now, I just want to clarify, most people in work-based schemes will be getting their full amount because of the way that the scheme is structured. But if you're unsure, go and check. Go speak to your HR department. They should be able to give you a clear answer. And if you're not getting that money, go get it, it's yours. Right, next one. If I put money into a global index fund monthly for 30 years, what should I consider a realistic return to be? 5% or higher? Well, I mean, I hope it's pretty decent because I'm banking on it too. But you say 5% there, and the global stock market's achieved about an 8 to 10% return over the last 100 years, but that's before inflation. So I would say that your 5%, if you were benchmarking a 5%, or if you were, forecasting on 5%, I should say, not benchmarking, then most pension companies and financial advisors would say that that was a realistic expectation of return, even after inflation. I think a lot of pension forecasts work on 4%, which is less than 5%, but it's in that ballpark. I personally would like to achieve 5% long term after inflation, so inflation adjusted. So in nominal terms, that might be 6 to 8%, say. I consider that to be conservative. Who knows, though, what the next 100 years will have in store for us. It might be much less. But, we work off the track record over the last 100 years, and that's been like an 8 to 9% nominal return, which is, about 5 to 6% after inflation. Okay. With an ISA, I can draw down tax-free whenever, whereas pensions are taxed but tax efficient when putting money in. Which works out better in the long run? It tends to be pensions. Don't miss. It tends to be pensions because most people in retirement drop down a tax bracket. So if you're a higher rate taxpayer now, so you're paying 40% tax, when you put the money into your pension, you get that 40% tax relief back. And then in retirement, you might structure it so you're a basic rate taxpayer, so you're only paying 20%, say, on today's levels. So, that means you get this big tax efficiency on the way in, and then you can structure it on the way out to pay even less. But the real power here is the combination of the ISA and the pension in retirement, because then you can draw up to your maximum tax-free allowances from the pension and then just top up your income from the ISA. It's that combination of the two that I think is powerful, and why I'm such an advocate of having an ISA alongside pension savings, even though the pension savings on paper are typically the best financial decision. I keep a list of all of the ISAs I use below if you want to look at setting one up. Yeah, next question. Should you have a rainy day fund alongside an emergency fund? With an emergency fund being focused on job loss, divorce, etc., and the rainy day fund for similar unanticipated expenses like new tyres, phone, appliance repairs? I think that that's probably a really sensible suggestion in a way. Emergency funds, like you say, for kind of life shit shows, getting divorced, things like that. But this kind of rainy day fund of maybe like $1,000 for when your tyre pops. Because if I look at my own finances, I keep my emergency fund in easy access savings accounts, or it was premium bonds in the past. I mix around where I put it so that I can get the best return on it, because it's a considerable amount of cash. But it's still not instant access. I don't think I could get at it straight away. What I would normally do is have a credit card that I use in the emergency, and then I pay that credit card off within the interest-free period. But having this kind of 1K that comes up, you would be dipping into it every month, wouldn't you? Because there's always something that kind of, oh, I've set my amount for the month that I'm going to spend, but then something comes along just to take 20% of it off you. So yeah, maybe that is a good idea to kind of split it up in that way. How would you store that money so that you wouldn't spend it? I don't know, because I'm just like I'm a nutter for spending money that's in my bank account. I have to lock it away, otherwise I'm just going to find a way to dip into it. Okay, I retired at 56 3 months ago. Congratulations. I still haven't finalised my approach to drawdown. I will soon have to start drawing down on my ISA, GIA and pension. Any thoughts on this? So I've already outlined my thoughts in terms of this combination approach to maximise tax efficiency. Another consideration is that pensions at the minute, I think this will change, are currently outside of your estate. So you can pass on your pension to loved ones without it incurring inheritance tax. I do think this will change because it's a bit of a loophole. But that means most people lean on their pensions heavily last for that reason. I think this is the kind of question or like conversation that you should have with a financial advisor, because I think they can add real value here. I think rather than saying, I'm going to hand over all of my assets to you, what you're going to do is you're going to pay them for a one-off session, sit down with them, and they can maybe structure and plan the withdrawals across all of those different products and accounts that you've got in the most tax efficient way. It might cost you a few £100s, but I think it's, peace of mind and it will save you a load in tax. Okay. Could you explain compound interest? Compound interest is simply getting a gain and then reinvesting that gain, and then the gain getting the gain. Again and again and again for the gains. So if I was to give you an example, if I take £10 and in the first year I get £1 in interest, a 10% return, I then invest that back into the pot. I've got £11, haven't I? Because I've added the £1 to the 10. I get 10% the next year. I'm going to get £1 and 10p because my gain is now in there. That process repeated over and over and over is the process of compounding. It's taking a gain, reinvesting it, and that then generating a gain long term. Okay? What happens to my ISA benefits if I move to a new country in retirement? You lose the ability to pay into the ISA, but you don't lose the ability to withdraw from the ISA tax-free. The gains that you've built up inside of that, they are protected from tax. The key thing is, though, that the country you move to might not recognise that. They might tax you. They might say, no, you have to pay tax on that. So you need to check at two angles. You've obviously got the UK angle, but then wherever you're moving to, you need to check how they treat taxable income from a foreign country. How do I identify how much ISA allowance I have left at any given point in a year? Is there anywhere I can go online to find out? Unfortunately, not at the minute, not that I've seen anyway. The government said they were going to build a portal so that people could track their ISAs more effectively, but yet to see that yet. The best way at the minute is to keep tabs on it yourself. If you log on to any broker, they typically tell you how much you paid into your ISA that year. And obviously you need to consider all of your ISAs, cash, LISA, things like this. But I know on Vanguard and Trading 212, they'll tell you the percentage of your ISA that you've used up that year. Unfortunately, you're just going to have to keep tabs on it. I've tried out several small ISAs in different Robo-advisor accounts. Should I keep them for a few more years so they've been invested for 5+ years, or should I move them into my current ISA, which has lower fees? I don't know what the 5+ years number is. It just seems like a number that you've plucked out of your head. Maybe it's because people are saying you need to be invested for 5 or more years that you think that's why. To be clear with that, people are saying invested in anything really across the board. I see people all the time saying, oh, I started this account here, but I made a mistake and I'm paying loads in fees now, but I don't want to sell it because it'll affect the compounding. It doesn't. If you take that money and reinvest it straight away, it's only that split second that you've moved it or a few minutes that affect the compounding. And if you can invest elsewhere for cheaper, you improve the compounding because you're removing the negative compounding effect of fees. Fees reverse compound. A 1% fee over a 30-year time horizon of investing will take about 25% of a portfolio off you. So they have this negative effect. I don't like robo-investors. People often talk about them as a great way to get into investing. And I think they probably are that, but I also think that they're an expensive middleman that charge a fee to just say, we'll simplify this for you, when all they're really doing is slapping people in global index funds. So yeah, if you are confident enough to pick your own investments and get away from those platforms, I think For me personally, I would do that. I did that in the past because they're just expensive. Right, I'm auto-enrolled into my company's pension scheme. Well done. I'm aware of the fact that most of the default funds have a very low risk appetite. However, I'm not confident enough in choosing a different fund offering. As with my limited knowledge of investing, it'd be like throwing a dart at a dartboard blindfolded. I also feel intimidated by the fact that it may have a big effect on my pension. What does a person like me do? First of all, well done for admitting that you're not comfortable, but being in a place where you're trying to improve yourself. I think that's all you can be doing. My advice is don't get out the default fund if you don't know or you're not sure. Just wait, learn, have a look around, and over time you will gain that confidence. Watch channels like mine and read other resources, and you will get to a place where you think, I can do this now, and that's fine. Don't rush it. Be honest with yourself about your competency and where you think you're at, and go from there. I like that question. Well done. Okay, next one. I maxed out my stocks and shares ISA this year, but I won't be able to do that in the next few years. However, I can still invest for now. Should I be using a general investment account? And how can I shift those investments into a stocks and shares ISA in the new tax year? Definitely in the bin. So you're basically saying, I won't be able to invest in the future, but I can invest more now, but I've already filled up my ISA allowance. Have you considered pensions because of the tax relief benefits there? I always think that you should be looking to maximize your pension and your ISA prior to utilizing a general investment account, unless you've got specific requirements to access that money sooner. If you are saying no, it needs to be an ISA, you can invest inside the general investment account and then sell down those investments underneath the allowances for things like capital gains tax and just move them into the ISA. Quite a simple process. I don't know how much money you're talking here, but I would just, if you want to avoid tax completely, just look to stay within the thresholds on an annual basis, which you can do because you won't be able to invest more money going forwards. Okay. As someone in their late 50s and just about to invest for my long-term retirement, what do I do given I haven't got the same time horizon as someone younger? You said it yourself, long-term retirement. Instead of thinking about retirement as an age where you kind of stop and then, you need your money by then, think of it as the chances are that you could live to 100. So that means if you're in your late 50s, you might have, 40 years left. And that's quite a long time horizon. That's the same timeline that someone from 20 to 60 gets, say. So I'm going to need to be invested for the entirety of my retirement because I want my money to generate a return. And instead of looking at it as, by 65, I need to have enough money to retire, I think of it as I'm going to invest throughout my lifetime. And what I need to do instead is prepare myself for retirement at that age. I've already alluded to it in previous questions. I'll do that by having a large cash buffer. So it's not that I'm going to change my retirement approach all that much as I get near retirement. It's just that I'm going to allocate more towards cash so that I can lean on that cash in times where the market isn't performing, so I'm not hurting my portfolio by withdrawing money from it when it's down. I think we need to look at investment and retirement in a different way. And things like state pension age, where people are retired, make people think that that's the age that everything needs to be done by. It's not. If I'm 90, I'm still going to have money in the market churning away because I want to be generating a return so that the money that I have can outrun inflation long term. Otherwise, if I just end up with a big pot of cash at 60, by the time I'm 90, I won't be able to buy anything with it. Right. Next. Why do certain funds or stocks have more than one listing, e.g. one in US dollars and one in sterling? And which is more beneficial? So you might see a fund listed in dollars or one listed in euros, one listed in pounds. I personally buy the pound version of the fund because I don't want to deal with the currency conversion. The conversion in currency will be happening behind the scenes. They're buying businesses in a global index, say all over the world. But I'd rather the fund provider do the currency conversion than me because I think that they'll get it for a cheaper rate. So where possible, I'm buying into investments that are listed in my domestic currency. Okay. In what situation does owning a home become the better financial decision versus renting and putting the extra capital into a pension? Very personal question. I mean, most of them are, but a rough rule of thumb that Rob Dix, who is a property guy, said to me is, if you're only living in the property for a couple of years, you probably should just rent it. If you plan to live in it long term, then buy it. Because what most people don't factor in is, if you're moving every 3 or 4 years, there's a lot of costs associated with that move. Things like stamp duty, legal fees, moving costs, they tend to be thousands. People don't realize it costs a lot of money to move house. All of that, when you factor it in, can outweigh the benefits that you might gain from buying. So, if you're not going to be there for very long, then maybe that's when it's time. There was an interesting point as well there where you make about investing the money instead. And that all comes down to flexibility as well. Obviously, investing in the stocks and shares, I said that money's highly liquid. The money that you have in your property isn't so easy to get your hands on. You could do a secured loan or whatever. But yeah, I don't see my house as an investment. I see it as something that a cost that I'm looking to remove from my life so that I can reduce the burden on my investments. I guess in that way it is an investment. It's an investment in reducing my monthly outgoings so that my investments, the thing that I put my money into to produce long-term inflation-beating returns, they don't have to work as hard to keep me going. I have no idea if I answered your question then. I just started talking a load of crap, didn't I? But I'm sorry, it's gone. It's in the bin. All of them are in the bin. Is there much variation in the buy-sell spread across different trading platforms? So UK brokers are not allowed to make money on the spread. So there shouldn't be that big a difference. What you might get though is differences in the execution. So some are slower than others, and that might mean that the price that you buy at shifts by the time that you get it. So, some people like more expensive brokers because they get more accuracy there, if you will. But yeah, there's not this whole thing of, they're making, the stocks are more expensive on this platform than they are on that platform, say. That shouldn't be happening in the UK. You're not allowed to make money on the bid-ask, the difference between the buy and sell price. What are your thoughts on buy now, pay later schemes like Monzo, Flex, Klarna, and PayPal? I seem to be in the habit of using them, but make sure I keep the debt interest free. If you're keeping the debt interest free, I guess there's no problem, because I would be a hypocrite to call this out, because this room, this studio, all the equipment in here, it was about £10,000. I had that cash, but I just put it on a credit card on interest free, because why would I use my cash that I can invest and get a return on when I can use someone else's? That's kind of buy now, pay later. I bought it now and paid it back later. But I do think that buy now, pay later convinces people that they can afford things that they can't. When I worked in debt services in the past, there was a company called Bright House. They might still exist. Quite predatory, but they would list all of their prices in their shops on a weekly. So they would be like, you can get this TV for £15 a week. They didn't tell you that you were paying it for, 15 years or whatever. I'm just pulling figures out of the air. Don't sue me, bro. But yeah, it would work out you were paying quite a high amount for the TV. But people would be like, it's like a TV and a fridge and a this and a that. I'm only paying out £120 a week. And then they would call the debt management company being like, I can't afford this anymore. But anyway, that's an example of buy now, pay later that's kind of shaped my opinion on it. I think if you're using it to buy large ticket items so that you don't have to use your cash and you can use someone else's and you're not incurring any interest, great. I think the large percentage of people are not doing that, and they're lying to themselves about if they can afford things or not. So, on the whole, I think the world would be a better place if we got rid of it. Do you think all things pensions should be moved to an independent public body that can plan for the long term without being as affected by short-term agendas? I don't know if it should be moved to an independent body, but I do think that we should remove the politicalize it. Yeah, we should get rid of the politics from the pensions. We should stop them using it as this hockey puck so that they can win votes. And instead, we should have a countrywide approach towards pensions so that everyone in the UK can benefit from them. So we have one of the largest pension pots on the planet. It's like 2 trillion or something like this. The UK holds a lot in pension assets, but they're broken up over thousands and thousands of different schemes. And each of those schemes has to have like a board of trustees that oversee the pension. To quote someone that was on the podcast, there's a lot of a lot of snouts in the trough taking fees from that pension. So I think if we consolidated them all down and had these bigger schemes, we could maybe be more strategic about everything, and that would probably be a better place to be. I'm new to investing. When I'm adding my money, the pot never grows, as my average buy-in price always is just below the actual price. Do I need a dip to actually get a return? Screw up the paper. No, you don't. You just need some time. You just need to give it time so that there's some significant gains in the market beyond your buy price. Just don't expect miracles overnight, but come back to us in 10 years when you're a seasoned vet and tell us how your gains are then. Okay. I've noticed that I can get 5.2% interest on pounds on trading 212, but 7% interest on Hungarian currency and 6% on Polish. Should I get that 7% and then cash out when pounds dip after the budget? I mean, it sounds like currency trading in a way, doesn't it? Because the whole when pound dips after the budget, I mean, maybe you're right. I don't know. What I would say is, have you considered currency conversion fees and all of that? What are they charging you for moving all of that around, and will that affect it at all? I don't currency trade, and I would consider that currency trading. It's not something that I would do personally. What are your thoughts on electric cars and purchasing on PCP? I don't have that many thoughts on electric cars. I quite like them. Some of them look nice. Always kind of impresses me when they creep up on me and I'm like, oh shit, I didn't even know that was there. And they're rapid. But yeah, I'm not one that's like, oh yeah, I love electric cars. I've got a car on the drive at the minute that's mine, it's fully paid off, and I'm going to run that thing into the ground. I start to take an interest in cars when that thing is run into the ground. Now, in terms of PCP, I think what PCP was a creation by the car industry to get more people into new cars because they needed to sell new cars. It's essentially glorified leasing, isn't it? Because of the balloon payment at the end. Now, you can refinance that balloon payment and pay that off so that you own the car eventually, or you can trade it in for a new car. But they just found a way to get more people into new cars. I'm not sure if it's a great thing. I don't think buying new cars is a great thing, right? And what maybe people do is they go, oh, I can have a brand new car for $300 a month, or this one that's 5 years old is also $300 a month, but they forget about that big balloon payment at the end. I did a car on PCP when I was younger. I regretted it because I was paying it off for years. Once you considered the 4 to 5 years of PCP, plus the 2 to 3 years of the HP, at the end, that's the thing, I'm running into the ground. I'm going to get every bit of juice out of that car. So yeah, I'm not in love with PCP. I think it's, a one-sided kind of benefit. People might disagree with me. I'm not a car person, so, How do I best compare pension funds to ensure my money is working as hard for me as it can? It feels overwhelming to select the optimal fund due to all the variables. Could you spell out the top variables to compare? Don't worry about being optimal. I hate this kind of like the best it can possibly be thing, because that stops people from making a decision and just doing the thing. Just, get started. So the things I look for are, I want a fund that the fees are low. For me personally, this is what I want. I want global exposure to the stock market, and I also want it to be passive, not active. So those are the three main filters that I'm looking to filter the fund out on. I'll then look at the funds in particular with those three filters. So I'm looking for a global fund that's passive, that's cheap. And I can collect all those together. I'm then going to look at, what does that fund track? Like what index does it track in particular? MSCI World, or like a FTSE global kind of index or something like this. And then I want to look at how well does that fund track that actual index? How good is it at kind of mirroring the ghost car, if you will? That kind of helps me whittle them out. Another thing that you could do if you're unsure is go away and find a fund that you think is a good fund in the normal world. Maybe you use, VWRL, Vanguard's World Fund. And then you go, okay, I'm going to compare these pension funds to that fund. Because one thing that I often find in pension funds is the allocations in terms of where they put your money are all over the place. So they might call themselves a global fund, but then you see that only 40% of the fund is in America and the rest is in England. If you compare that to VWRL and you look at how they distribute their funds across the globe, you'll see that that's vastly different very quickly. And you'll be able to say, well, that's not the kind of global fund that I want. There's no easy answer to this, but the rewards for getting out of the default funds long term, I believe, are significant. So it's worth putting in a bit of time and just having a few top line filters that you can kind of whittle things down on. If you're unsure though, there's nothing wrong with being in the default long term. Just be in your work-based scheme. That's the main thing. Okay, I'm 19 years old. My employer's pension scheme matches up to 7%, and I've been contributing 10% to try to benefit from compounding as early as possible. I was wondering if I should remove my additional contributions and contribute to a LISA instead. 19-year-old with their head screwed on. I wish I had my head screwed on now, let alone back then. So you probably identified that you could take that additional payment, the extra few percentage points that you're overpaying there, put that into a LISA and get the 25% top up from the government. Obviously, it depends on what tax band you're in here. If you're a basic rate taxpayer, then that 25% top up is more than the 20% that you would get. But if you're higher rate, you could just stick it into pension and get the tax relief. As well as that, what if your company pension, which seems quite generous, operates on salary sacrifice and shares the national insurance benefits with you? It might be that it's better to put that money into that scheme. And then, why the LISA? Is it just for the 25%? Do you know about the restrictions? Are you looking to buy a house? Obviously, if you're looking to buy a house, that's a specific goal that you have in mind, and then the LISA potentially could work. I can't answer the question for you. All I would say is at your age, to be asking these questions, you're doing very well. So, congratulations and well done for being you. And, by the time you're 30, if you stick at it consistently doing all of this, all your mates are going to hate you. Absolutely hate you. You're going to be that guy at the pub that's just like, oh yeah, I got 200 grand in investments by the age of 30 or whatever. So yeah, keep doing what you're doing. What would you do if the market's crashed and you're in your early 60s thinking of retiring within the next few years or so? I personally will have my cash buffer of 3 years that will allow me to retire anyway, and I'll just basically lean on that cash for those few years until it recovers, and then replenish those 3 years once it recovers. If I don't have that, then I might consider waiting a year before retiring so as to not kick the portfolio when it's down. This thing is called sequencing risk, and this is the idea that the first few years of retirement are crucial. If a portfolio if the market dips in the first few years and you take money out of that portfolio, you shorten the lifespan of your portfolio significantly. That 1 year there might shave 5 to 10 years off the back end. So it's really important, that timing point around when you retire. So if you're not prepared with large cash reserves, or you're out of stocks in a meaningful way with cash equivalents so that you can lean on them, you might just have to delay the retirement. This is why I think it's important, working up to a retirement age, to think about how you're positioned if the worst was to happen. And my version of that positioning is a large cash buffer held in the highest interest savings account that I can get, that I can lean on for a couple of years if the market was to go sideways. Next one, I maxed out my 20k tax-free limit and also 10k personal savings. I'm a higher rate taxpayer. Given that I'll be paying tax on whatever comes next, what should I do? Invest, keep my money, buy a house? So I don't understand where you're at with some of this. So 20k tax-free limit, does that mean your ISA? Does that mean you've filled your ISA? And also 10k personal savings. Is that cash savings? I'm unclear on like kind of the distribution of your funds here. But what I would say is, if you filled your ISA, then look at pensions. That's the best way of going about things, especially if you can salary sacrifice or pay into a pension to reduce your overall income. If you're a high rate taxpayer, you can pay into your pension to reduce the amount of high rate tax that you pay. Some people can even cross over the threshold again back into basic rate, saving themselves that additional bit. The key thing is though, tax is always on a gain, right? Or, in most cases it is. There's certain positions where tax ruins you. You end up losing almost more than you gain. But for most people, you're being taxed on a gain. And what I mean by that is, people are often scared about earning higher rate tax or investing in taxable accounts because they're like, oh, it's going to get taxed. You're only getting taxed on the gain. You're going to be doing better than if you weren't. It's better to invest that money than just to burn it, essentially. But I also will say, you're asking questions about buying a house and keeping the money or living life. I think both of those are good things to do. Live a bit of life and keep a bit of money. I certainly have to work on living a bit of life myself, making sure that I don't just squirrel everything away. It's getting a bit like, therapy session now, isn't it? But yeah, I can't answer that question too specifically because I'm not sure of the makeup of the accounts there, sorry. Buckets today. As an investor, is it more sensible to be a dividend investor rather than chase capital gains, as you can use the compounded money for dividends to build wealth? This debate is a huge debate, and it's one that I can't cover right here, right now. So what I'll do is I'll link a few videos below that I think give you both sides of this. I think Toby and Ben Felix cover the why dividends are not good debate perfectly. And then I'll find some people that look at the why the dividends are. TLDR, some people would argue that a dividend leaving a company bank account is money leaving that business. So if they have £1,000 in their bank and they give £100 of it away, they now only have 900. So that company is worth less. So by the dividend leaving, the stock price drops to accommodate for that. And then on the other side, people would argue, so basically they're saying the dividend doesn't matter. But on the other side, people would argue, well, that is cash to me that I can use in a way that I want to reinvest within that business, building up my position. So, there's a clear debate. I think it's whatever gets you excited, whatever makes you ride the ride. And for some people, they love that dividend notification. They love that process of reinvestment, and they love tracking them and watching them go up every year. And if that's the thing that keeps you on the horse, then do it. I hate optimal. I just want you to do the thing. So for you, if that's dividend investing and that's the thing that lights your fire, do it. Because at the age of 60, you might sit there and a guy go, wow, I did, growth investing and I got an extra 2% a year. And it's like, well, I don't give a shit. I'm rich, you're rich, we're all rich. It's great. If I were to spend some capital to launch my own business, what percentage of my total net worth or liquid net worth would be a reasonable amount to risk? How confident are you in the idea? I quit my full-time job to go all in on this YouTube channel, which basically cost me 100 grand a year. So it was a significant investment, but I was confident of the idea. So I just spat on the table because I'd already launched the channel and knew it worked. So, I went for it. If this is a fresh idea, what I would encourage you to do is find a way to launch it without significant cost, without that burden. Certain businesses take massive amounts of money to get off the ground. I get that. But is there a version of your business, like a minimum viable product that you can launch without this big cost so that you can test if it's worth backing? I would look at it like that rather than going, 10% of my net worth is what I should risk. Put your time into it, not your money to start with. I'm staggered by the high charges and low returns on my previous workplace pensions. Can you compare combining my previous pensions versus setting up a SIPP? Well, I guess if you were combining your previous pensions, one place that you would put them is a SIPP. Maybe you're talking about combining all previous pensions into your current workplace pension. You could do that as well. But yeah, combining them into a SIPP is not a hard process. But you need to know that where you're going to put that money in terms of what funds you're going to buy or investments. And also, is there any risks from moving away from old pensions where you lose certain benefits? There's things like guaranteed annuity rates and protected tax-free cash amounts and things like this that are quite valuable within certain pensions that you don't want to lose, especially the older the pension, the more likely you are to have these benefits. Contact the pension provider and check with them if there are any benefits that you could lose by consolidating out of those pensions. But the actual process is quite straightforward. Would you have any warnings around going with growth funds in the first few years and then more into dividend share funds in the future? So, what if growth investing underperforms? What if dividend investing underperforms? Growth investing has done well in recent years, but in the past, value investing did better. And there's a lot of investors that think that value will come back. I don't think that, unless you really know what you're doing and why you're doing it, you've got to have some serious conviction in these kinds of approaches to be saying, I'm going to do that initially because I think that's going to do better. I don't know. I think the pitfall is one of the strategies underperforms, and then you're like, well, I don't really know why. Once you've got your pot of money at the other end of the investing cycle, how would you draw down from it in good market conditions or bad market conditions? Kobe. It's this 3-year waterfall conveyor belt thing where on an annual basis in a good to medium year, I might sell, say, 4% of the portfolio or whatever it is needed to replenish my living costs. And then in bad years, I don't sell and I lean more into the cash savings to protect the portfolio. Okay. I want my money to work hard for me, but not for the evil corporations of the world. ESG seemed like the answer, but when I look at the companies making up some of the Vanguard ESG funds, I was disappointed to see the likes of Nestle and Shell. Any advice on finding funds with a strong ethical message? The less harm you want to do to the world, the more you have to work at it. It's much easier for me to be fat than it is to be fit. And in a way, it's kind of the same here. Unfortunately, it's much easier for me to just, destroy the world than it is to save it. So for you personally, if you have a strong moral compass, you're going to need to do more work to fit those morals. What that means in reality is you're going to need to do good digging into the ESG components of the funds and find specific funds that are aligned with your morals. And the way that I would do that is define exactly what you want. Obviously, you've mentioned Shell there and you mentioned Nestle. So corporate scandals and oil, and there's a few things in there, baby milk powder and things like that with the Nestle scandals, weren't they? You need to define exactly what it is and what your version of ethical is. You then need to find a fund that does it. I don't think that's going to be easy for you. And I think in reality, if you want to do this really well, then you're going to need to look at individual companies that suit your kind of your view of the world. But you're also going to need to make sure that those companies are good investments. And what that means is you're going to need to value them and decide, is this a good business? I'll point to Oatly, like I always do. People started buying into Oatly and thinking, oat milk's the future. The problem with oat milk is it's very easy to copy it. It's oats and water essentially with a few emulsifiers in there. So this was seen as like, the next big thing. But then the supermarkets just rip off the product and provide cheaper alternatives, and it destroys that business essentially. So while it might be a good product, and while people might like the ethics, I mean, there's debates around Oatly's ethics because of certain things that I've seen. It might not be a good business, and that's the added element to this, because that's why you're investing after all. So yeah, unfortunately, like being a vegan, say, you have to work harder at it to back or to live that moral standard. So I don't have the answer for you there, unfortunately. Is it true that you can only buy a new build house with funds from a LISA? No, you can buy any home. If I can get 5% interest on savings with no risk, shouldn't I just do that? Long term, the stock market tends to outperform interest on bank accounts. So, you might be getting 5% now. I doubt we're going to get that long term, because what will happen is interest rates will decline once inflation is under wraps, and the rates that you achieve in the bank will follow that. Also as well, risk-free is a funny term, because I understand what you're saying about stock market risk. There's also a risk that applies to bank accounts, which is the impact of inflation. And you need to consider that. If the interest rate tends to track the rate of inflation, once you minus away that rate of inflation, so let's say, long-term interest rates sit at 3% or 4%, inflation is at 2%, you're only getting a 2% above inflation return, whereas with the stock market, you tend to do much better than that. For building wealth long-term, the stock market has a proven track record above cash. I have a few defined contribution pots from past employers. Is there much benefit to moving from my pension into a SIPP? What are the risks? Benefits are more control, less fees. I would say the big ones. In terms of you can control where the money goes, so you can pick better investments and you can pay less in fees. The risks are that you move out of a pension that has a lot of benefits attached to it. So the extreme example of that would be you move away from a defined benefit scheme, such as like an NHS pension, and you pull all your money out of that to put it into a DC scheme. Obviously not a good thing to do, but there's varying levels to that. There's all sorts of there's all sorts of pension. I'll start again. There's all sorts of pension benefits that are not just, how much money you've got in there. There's things around annuities and all sorts. So it's worth checking on those, especially if they're from older employment. I've answered that question in a few ways, roundabout way, but I'll keep answering it. So, in case people don't watch the whole video. How would you look to optimize returns over the next 2 to 3 years? I would personally not look to optimize returns over a 2 to 3 year period, because I think that will lead to speculative behavior. It will lead to you taking risks and going into investments that, might not be that safe or secure. So for example, if I was saying, I need to make as much money as I can in the next 12 months, well, then you start to look at things like index funds aren't going to do it for you, are they? They're going to be like, well, they're boring. So you start looking at options trading, CFDs and crypto, and it just leads you down a path. If you've only got 1 to 3 years to invest, well, I would challenge that and say you probably shouldn't be investing, because that's too short of a time horizon. If you're saying, I just want to maximize, I just want to make as much money as I can in the next 1 to 3 years, I think, you need to broaden that timeline. I don't think that looking over 1 to 3 years is conducive to producing good returns, unless you really know what you're doing. And I think most people don't know what they're doing. I do think there are highly skilled individuals out there that can trade the markets and make shed loads of cash, but I think most people are not that. They just haven't put in the hours. I'm not saying they're stupid or anything, but think of all the time that you've put into your career to get into where you are. It's like me walking into your day job tomorrow and going, give me 2 days and 5 YouTube videos and I'll be as good as you. I have a financial advisor that manages my SIPP, but I manage my own ISA. What is the best way to confirm that I'm ready to manage all of my financial affairs? What exactly is the level of competence required? Advisors provide multiple services, and I think that the value that they offer shifts over the lifetime of you being with them. I think there's a lot of value in getting people started and getting them set up. I think there's a lot of value in pension and retirement planning at the end and telling people how to take money out of that and prepare for that. It's this period in the middle where I think the value can become a bit questionable, in the sense of they might take a recurring fee as a percentage of your assets under management. So they take a percentage out of your investment pie every single month or year for managing your investments. But a lot of the time, they might just be sticking your money into a global index fund. I think what people realize after a while is that they can do that for themselves. And I think it's that portion of that can be easily replaced potentially. But I think you need to ask yourself some important questions. First of all, I would go away and look at what you're invested in by the financial advisor and say, could I replicate that? Do I know what that is? Am I confident in saying like, this is what this is? And I don't think it's good enough for me. So in my example, I can look at what a financial advisor's invested in, and I can 9 times out of 10 be like, oh, it's a global index fund with some bond allocation. I just know looking at it. So I know I could replicate that very easily for cheaper, or I think I could improve the return by having a higher percentage of equity. Also as well, the other thing that a financial advisor does that I've not mentioned is they provide support in times of crashes. Over a 30, 40-year time horizon, you will see a decline. You'll see a few. And the question is, do you have the stomach in that negative time to weather the storm and stick to the plan? Or would you benefit from the therapy aspect of being able to call someone who talks you back from the edge? And I think most financial advisors, if they were honest with people, which a lot of them are, would say that their main role is of a therapist and not as a financial wizard. Most of the time what they're doing is convincing their clients that everything will be okay, that they should put more money into the markets, they should keep going, all of this kind of stuff. So yeah, if you think you can replace those, then maybe that's the level of competence, but you just need to be honest with yourself. I don't want to discredit this industry. They provide a lot of value to a lot of people, and there's a lot of people out there that are just like, I just want to be with an advisor, that's fine. But I do think with a little bit of knowledge, you can invest for yourself potentially as well. And that's kind of the question you need to be asking yourself. When is it a good idea to switch an accumulating fund over to an income fund? When you need the income. So if you want that fund to pay you the income, rebound straight into the basket. If you want that fund to pay you income, you switch. So if you want to live off that income, for example, or if you're just like me and you love getting that income as a dividend so that you can track it, so that you can reinvest it. Because I just, I'm into that. What are your thoughts on staying 100% invested in equities rather than de-risking as we move into retirement? I've kind of addressed this in a roundabout way, but my view is that I don't think I will personally de-risk at retirement. I will just de-risk through having that 3 years worth of cash. Again, my plans could change and I will keep you updated on how they change long term. I'm 35, I'm not 65. And I think when we're young, we think we know it all. And the older I get, the more I realized I didn't know anything last year, let alone 20, 30 years ago. So, the gap between 35 and 65 is pretty big. I'm going to learn a lot of stuff and gain a lot of wisdom over that time, I hope. So this might change, but what I would encourage people to do, instead of saying 100% equities, is to look at themselves as a portfolio. You are the middle aspect of the portfolio and everything you own revolves around that. I could say that all of the technology in this room is part of my portfolio because I could sell it and realize value from it. And you might say then that I'm overexposed to physical tech. Or you might own a home, like a big home, 700 grand, 800 grand, and then have nothing in investments. And that's your house that you live in, but you could turn around then and go, you're overexposed to property. It's your life portfolio, right? So my equity portion of my portfolio will likely always be 100% equities, but I will increase the allocation to cash so that I have that buffer. And that is essentially de-risking. I am de-risking there because in my life portfolio, in the portfolio of me, I'm, increasing the cash allocation near retirement so that I have a buffer. So yeah, I hope that answers your question. I can't access a credit card because of being a student. Would adding myself as a secondary card holder to a parent's account help improve my credit score? Any other suggestions would be appreciated. It might help you improve your credit score a little bit, but nothing's going to improve your credit score like time. Get on the electoral roll, get some direct debits, pay those direct debits. If you've got a student overdraft, keep that nice and clean. Even better, if you can pay the overdraft off every month and stuff and show that you have that repayment history instead of living in it, that's really going to improve your credit rating as well. But the main thing is it takes time. A credit rating is more a measure of your ability to repay and honor your arrangements over time than it is a score on any given day. So yeah, I would say, if getting a credit card when I was a student is one of the worst things I've ever done. So, don't rush into that party. I could save 5 to 15% of my income, but with inflation as high as it is it just better for me to spend my money? I love that person. Should I just, forget it and spend all my cash? We invest to outrun inflation. That's the main reason we invest, to protect our purchasing power over time. So it doesn't matter if it's only £1 or £1 million a month. We invest it so that long-term inflation doesn't eat away at that money. I have a workplace pension with around 400k in it at the moment. This is a large sum of money for me, and I've struggled to have the confidence to move it away. Is there a good time to do a transfer, or should I just get on with it? That's a large amount of money for anyone, mate. So I understand your trepidation and, your concern. I don't know why you're transferring it, but let's assume that you're doing it for a good reason. Why don't you just do a partial transfer, move a little bit of the cash, and just kind of see how that sits with you and how you feel, and make sure, you're not sending it to the wrong place. Obviously be careful, because there's a lot of pension scams and things at the minute. So again, I don't know why you're transferring it, but I would just make sure that it's for a good reason and that, you've tested the route. So just send a little bit and make sure that, the money doesn't disappear or anything before you move the whole lot. How do you stay informed and continuously improve your financial knowledge and expertise? What are some personal habits and routines that you believe contribute significantly to your success in finance? Okay, so I stay informed because it's my job to. My job is to research these things, and that certainly helps. I would say that, if you are the kind of person that likes this thing, you will consume content around it. Why sat here watching an hour-long video of me or whatever? So you kind of, if you've got the bug, you'll enjoy it. But don't force yourself, because investing is one of those wonderful things where the simple route is often the best. And if all you do is buy a global index or an American index and you chug away at that for 34 years and you just forget it, 30, 40 years, and you just forget about it, by the end, you probably have done okay. And you might have even done better than the people that obsess over it all the time. So yeah, if it's not your thing to be deep into it and researching it, I'm not sure that that's a bad thing. In terms of the things that have contributed to my financial success, really messing up in my earlier life, financially, gave me the skill set that I have today. But the main thing is my patience and, my ability to not really get flustered when the market drops anymore. And you get that through time. So I'll give a recent example. The S&P 500 dropped quite significantly recently. And, the initial thought as a finance creator is, let's make a video on this because it'll get a lot of views. Talk about why the market is crashing and what people need to know and these kind of things. I then saw a few really good creators made some content on that. And I was like, I've got nothing else to add to this. And I'll just ignore it because that's what I'm doing. That's what I'm doing in my day-to-day life. It doesn't even register. Sometimes I don't even know that the stock market's dropped until people tell me about it, because I'm just not looking at that, There we go. What is your advice for short-term savings? We want to buy a bigger house in 4 years and are saving for that. We currently add monthly savings to a cash ISA with a high interest rate. Is an index fund a bad choice considering it is not a long-term investment? Yes, I think putting the money for a house into an index fund is bad, because it could all go well year on year and then in the 4th year it drops 30% or something and you're like, So yeah, I think you're probably doing the right thing there. At what point is paying for a financial advisor highly advisable? I think I've kind of covered this, but for me personally, again, it's at the end with the retirement planning piece. I think they add a lot of value there. But if you feel that you can't invest for yourself without support of someone else, then go for it. It's like a personal trainer in the gym. Some people just need that person there next to them, encouraging them and pushing them along. And to some people, spending £40 an hour or whatever it is for a personal trainer is absolutely mental. But if it gets you to the result that you want, then that's okay. Recently, I came into some inheritance, about 96k. I wanted to know, what would you do with the money to generate more income in the UK market currently? First of all, that's a lot of cash, right? So you've got loads of options here. You could invest in property. So you could buy 1 or 2 potentially with that level of deposit, if you say it's like 250 grand property or whatever. And the benefit there is of the returns that generates long term is you benefiting from leverage. So you take control of the whole property with a deposit that isn't equal to the whole value. It's that debt component. So, you put, say, 25 grand down on a 100 grand property. I know you can't find those kind of properties. I'm just trying to make it, simple to understand. You get the benefit of any increase in the price. So if prices go up 10% and it goes up 10 grand, you get to keep that whole 10 grand and you've only put 25 in. Also, you get the full benefit of the rent as well. So that leverage component amplifies returns long term, but they are more effort. You could stick money into pension, get an instant return in the form of a tax relief. You could stick money into ISAs as well. You could invest in yourself, which I think is the best way for you to improve your long-term income, to upskill, to do the things that will get you a promotion or like a side hustle or something like that. That's kind of what I did. And it's, that's been the best investment I've ever made. So there's plenty of options. There's nothing really that's massively like sexy. It's not like, oh, stick it here and it'll treble in 6 weeks. But I would also push back on this slightly and say, you need to take some of that money, just a portion of it, whatever you want, and do something completely epic in memory of the person that left you that cash. They left you that cash to help secure you, sure. But, I'm sure there was a part of them that also wanted you to go have a good time. So do that in their name and, rip it up a bit. That is what I would do. Vegas all on red. What is the best SIPP on the market? Honestly, I have no idea. Mine's currently with Vanguard because that's who it's always been with, and Vanguard. InvestEngine I know is probably cheaper than Vanguard at the minute, and I also know that Trading 212 in the next 30 days to 2 months or whatever are launching one that will probably be free. When I say free, I mean like free in terms of how Trading 212 operate. So no platform fee, as an example. I will likely, when that opens, keep my current SIPP with Vanguard, but start trying that out and report back on it. I don't know. I need to do a bit of digging. I've been a bit kind of like relaxed with my SIPP, just leaving it with Vanguard, and it is probably time I did a shop around. So I will do that. Okay. I max out my workplace pension, ISA and LISA every year. I want to retire in my 40s, but I can't access my pension or LISA until I'm in my late 50s or older, meaning I can't retire as early as I theoretically could given my net worth. Any tips? You have a clear plan there and a clear goal in mind of what you want to achieve. So now you have to structure your portfolio to achieve that goal. What that means is, with you, what you've identified is your LISA and pension, you can't access them at the minute. So you need to have enough money in your ISA to bridge that gap. And that's kind of how I would be approaching it. So I'd also say as well that most people who retire very early then decide that, they want to earn money in some capacity. So maybe you could build that into your model and say, well, I'm still going to earn some money freelancing or whatever I do. But yeah, if you've got a specific goal in mind like yours, which is great, you just need to set up your assets and your portfolio in a way that support that goal. So that might mean paying less into pension and more into ISA so that you can support yourself. What are your thoughts on real estate as an investment? I think I covered this one. I think, long term, it's a great investment. I think the benefit is the leverage component and that ability to take control of a big asset with a small amount of money, and that leverage is quite cheap and not that volatile. Leverage within stocks is mental. It can drop and you can just get wiped out. It doesn't really happen like that with property as long as you're paying the mortgage. What I will say is though, there is a lot more effort with property. No one's calling me at 4 a.m. to tell me my stock portfolio needs its light bulb changing or that a bunch of squatters have moved in or something like this, right? Stocks tend to be a lot less effort. Also, I don't think it's realistic to expect the same level of returns in property over the next 30 years as we've seen in the last 30 years. I just think that, what makes the previous generation rich might not work for the next. And, maybe they do keep going crazy, but I would, model my expectations on the fact that it was going to be just above inflation in terms of the return and the growth of the value of the property, not these kind of crazy 10x gains that we've seen in the last few decades. But obviously you also have the component of the rent, which is nice. So yeah, property investment, like any investment, if you buy well and you hold long term, I think will do you right. I currently earn 45k, but there are next to no benefits. They match the 3% pension contribution, that's it. I enjoy the job, but feel like I'm missing out on financial compensation via benefits. Do you think it's worth potentially taking a pay cut to 40k if there are good benefits packages from other employers? Higher pensions, medical contributions, paid travel, etc. We need to start looking at as a group of employees, as a country, at pensions and things like their real pay, because they are significant benefits. And I think when we're negotiating or talking about starting a job, you should be asking, what contribution level have you got on the pension and how much will you match and all these things, because it's very real money. The question there, though, about dropping from 45 to 40, that's over a 10% pay cut. And I just challenge whether the benefits aside from that are worth more than 10% of your pay. I also think if you're a really good employee, you could probably go to these other companies and say, what will you offer me? And rather than taking a pay cut, get a pay rise. Try and get 50k with all the benefits and then use that as leverage with your other employer. I don't know if taking a pay cut of over 10% is going to be worth it for you. I don't know how generous the benefits are on the other side. It just seems like quite a lot. If you have money invested outside of an ISA, can you make a portion of that investment into an ISA? For example, if you start with 50k and you invest in index funds, 20k in an ISA and 30k outside of the ISA, in year 2, can you transfer 20k of the 30k into an ISA? And assuming growth of 10%, will there be any capital gains tax to be considered? When you sell investments outside of an ISA or a tax account, that is a taxable event. So depending on any capital gain that you've locked in that year, you may incur capital gains. So you just need to check what the current capital gains allowance is for that year and just stay under that. So don't lock in a gain above that. And then you can move 20k into an ISA every year. So yeah, you could move that money into an ISA, but you would be using up your ISA allowance. Okay. I'm 19 and not in uni. How much money should I have in an emergency fund before I start investing? And where is a good idea to store emergency funds? Okay. First of all, great, 19, love it, investing, all these questions. I think this whole thing about you need 3 months worth of emergency funds before you ever start investing, I don't think that's right personally, because I think most people just want to get started, don't they? They just want to, get a bit of investing going, and 3 months worth of living costs as a student, bloody hell, it'd have taken me 10 years to save that up. So, I don't think that you need to do one before the other, because also think about emergency funds. You don't go from 0 to 3 months in an instant. After month 1, you have a couple £100, month 2, 400, whatever. And within a few months, you have £1,000, and that's probably enough to cover most emergencies. So you're building this emergency fund as you go. I personally would do a little bit of both, just because I think it kind of scratches the itch, and I know people want to get started with investing. And I think if you're plugging away trying to build up an emergency fund 3 months, you lose the will to live a little bit. 50-50 split, 70-30, whatever you want to do a bit of both. And then secondly, where to keep them, that's completely up to you. High interest savings, premium bonds maybe, it's a bit of fun, isn't it? But because interest rates are better on savings accounts nowadays, that trade-off of the return on savings accounts versus the uncertainty of premium bonds has become wider. In the past, when interest rates were like 1%, it was like, I might as well just give it a go on the premium bonds. That's not as clear anymore, I don't think. General advice seems to be buy one global index, it's all you need. But if you have considerable sums invested, is it not wise to have multiple similar index funds from different companies to mitigate risks or have extra peace of mind? If it helps you sleep at night, then yeah, go for it. But these companies like Vanguard and BlackRock, which tend to be the fund providers, are like multi-trillion-dollar companies, way too big to fail. If these guys fail, they're taking down the global economy with them. So I think you can be relatively, you're relatively safe. Also, as well as that, you have the Financial Services Compensation Scheme protection. But before that, you have all the CAS rules, which mean that your investments need to be ring-fenced separate to the company's assets. So in theory, if Vanguard went under, there'd be these massive pools of investor funds just sat there separate to Vanguard's assets, if you will, in the UK. So there's layers of protection that exist. But yeah, I have different funds with different fund providers because, every year I might buy a different fund because it becomes cheaper or I want to try it out. And I don't see any harm in that. Again, what keeps you on the horse, what helps you sleep at night, do that thing because it will get you to where you need to go in long run. Do you have an all-weather portfolio like Ray Dalio, but for ETFs? No, I don't, unfortunately. No, I don't. Pretty simple. All weather is all world to me. Just buy the whole world and hope for the best. If the thing stops spinning, well, we're all fucked anyway, so it doesn't matter. What are your thoughts on alternative investments like whiskey, guitars, stamps, pens, watches, and general collectibles? If you know a lot about them, then great. I often hear people going, oh, Lego has been the best performing investment on the planet. What the fuck do you know about Lego though? If you know that like this wheel of Lego is worth more than this one, or this set is better than that one, go for it. You know, if you're into that stuff, go for it. But I know lads that won't invest in the stock market but own a barrel of whiskey in Scotland and have never struck a sip of whiskey in their life. Like, it makes no sense to me. Only collect something if you're into the collection. And it's the people who know the intricacies and the nuance of that thing that will make the money in it. If you don't know that, then stay well clear. These companies peddling you shares in art and whiskey and things like this, I just think if they knew what they were doing, they'd just be doing it behind closed doors to themselves. They wouldn't be telling you that they could do it and you need to give them 50 quid a month or whatever. So yeah. Have you ever experienced a large market crash and what was your reaction? If so, I would like to know how you'd react should we have a massive correction. Yes, I've experienced a few. The dot-com bubble, but I was about 11, so I didn't really know what was going on, but I kind of remember the chat. The '08 crash, I remember very clearly. It was the first year after I went to university and I was doing a business degree. So, you know, it was right there. And I remember then over the next 10 years, seeing the market recover and not really participating in it meaningfully and being like, crap, like, you know, dipping in and out, but just not taking it that serious and being like, wow, people have made a lot of money since then. And then the most recent one was the COVID crash in 2020, March, May. The market's dropped real quick. And my reaction, which kind of will tell you how I would react to another one, I was buying an investment property at the time, like an Airbnb. And I just cancelled that transaction so that I could pull the money out and I could chuck it into the market. So I took the whole house deposit, called the estate agent, said, yeah, I'm not doing it. They're like, why? And I was like, oh, uncertainty around COVID. Ooh. And so I cancelled it and I put all the money in the market the next day. Well, what I actually did was drip fed into the market. So I was buying like £1,000 worth of global ETFs on a daily basis. I was buying Google stock as well because that was tanking and I was like, people are still searching for shit. This was before AI and all of that. So yeah, that's how I reacted and it rebounded and I made a load of money very quickly. If the market tanked now, I'd do the exact same. I would be like scrambling for cash to throw it in because I tend to not have that much cash on hand. So yeah, I would be trying to pump cash into the market if there was a big decline like that again. Is my Help to Buy ISA worth it if I'm expecting to buy a house worth more than 250k outside of London? It's on a lower interest rate. Have a look at seeing if you can switch that over to a ISA. I don't know what the rules are now and if there's, you know, if you're kind of like missed out there, but the limit there is 450k. So I'm sure that would help. I'll include an article below to help you out. Should I diversify my pension in the same way that I diversify my ISA and general investment account? I currently split my portfolio like this: 50% index funds, 10% individual stocks, 25% property, 5% commodities, 5% crypto, 5% cash and cash-like. You sound quite well diversified and, you know, into different things. Again, I would encourage you to view everything as like your life portfolio. You are the portfolio. Everything that you own forms part of your total portfolio and view it like that. But what I would say is that the pension tends to be the last thing that we access, so it's got the longest time to invest. And for that reason, I personally, again, not investment advice, would want to expose that cash to the highest potential return. And I tend to think that that's within the stock market. Obviously, people would argue crypto and stuff, but I just don't think it's got the track record for that currently. And I have my own crypto allocation, but it's not within a pension wrapper, obviously. Okay. Does saving into my pension aggressively between now and retirement with the idea of paying the balance of my mortgage off with the 25% lump sum make sense? I have 47k in my pension and I plan to have 2 million in savings by the time I retire. Love the enthusiasm and the big goal. You go get that. I think, yeah, a lot of people use that 25% lump sum to pay off their house. And what I would say is that, the benefit of putting money into a pension, getting that tax relief that you get, and then in compounding that within the market would probably beat overpaying a mortgage in most cases, because all you get with the overpaying of the mortgage is, the saving on the mortgage. You're not getting tax relief plus the compounding effect. Is it worth paying off a mortgage early in the UK? Well, there you go. Answered that one, I think. I mean, it's up to you. If it helps you sleep at night, again, then go for it. Some people love the idea of having the mortgage cleared. For me personally, I just want as much money in the market and in investments as I can, because I think long term that's a better rate of return than I can get from paying off the mortgage early. Obviously, if mortgage interest rates stayed at like 7-8% long term, that would change that. I don't think that they're going to. I think that, we're seeing quite a short spike in high rates, if you will, and that interest rates will come down further from here. I get the argument that rates are at a normal level now, but I just think the Bank of England wants rates lower than they are now, and mortgage rates will be lower than that as well. Can you explain cost averaging within the market? People seem to understand the theory, but not when emotions come into play. There's a film called Boiler Room, which is one of my favourite ever movies. And he has this lovely way of kind of describing dollar cost averaging in that, or cost averaging, when he's trying to sell aggressively to a client on the phone. And he basically has the phone like this, and he's like, if I had something that was worth 10 today and I sold it to you and then it was worth 5 tomorrow, would you buy it? Because if it drops from 10 to 5 and then it goes back up to 10, you've made 5, even though the price hasn't changed. And the guy buys on that basis, right? Because this stock's falling. So that's kind of dollar cost average in a way. You buy at all these different price points. You consistently buy into the market, and over time, all these different price points that you're buying at, some high, some low, equals this, you're just buying into the long-term trend of the market going upwards. But even in a sideways market, by dollar cost averaging in that way, you could make money. Because, if it goes from 10 to 5 and then back to 10 again, and you bought at 5, you've made 5, even though the price hasn't gone above, the all-time high in that example. So yeah, dollar cost averaging is this consistent investment approach on a weekly, monthly, whatever basis into the market, not caring about the price and just buying it at whatever it's at that time, on the basis that sometimes you'll buy high, sometimes you'll buy low, but over a long period of time that will produce a good return for you. And it's shown, with examples in history, that dollar cost averaging approach is a very sensible approach for most investors versus trying to time the market, because we tend to be awful at timing the market. Do you diversify your cash into Forex like Euro or US dollars? No, I don't. I don't like thinking about currencies. I just think it's another layer of complexity, and I think it kind of all comes out in the wash. And I think, by buying a global index fund, I'm getting exposure to currencies all over the world as well. And a lot of companies that operate in one currency are collecting profits from other countries in different currencies. It's a big old mess. So yeah, I don't try and hedge currencies or think about those kind of things personally. When is the right time to cash in terms of cycles for ETFs and shares? Timing cannot be done, but waiting until the last minute until you need the money is also extremely risky. Do you have a formula like all-time high cash out, then all-time low cash in? Again, this sounds like trying to time the market, and it's not something that I'm going to do personally. I'm just going to have my 3-year cash buffer as I approach retirement so that I can decide when I pull on my portfolio. My daughter is 22 years old and is a midwife with the NHS. She's a hero. I know she will get an NHS pension, but she wants to start a separate one as the state pension might be gone by her retirement. Where would it be best to put £100 a month to start with? I think, this is where ISAs are great, because one thing about pensions is the rules change. You have to consider things like the lifetime allowance, which could be brought back in, say, and pensions through the NHS tend to be quite valuable and can fall foul of things like lifetime allowance. It might be sensible for your daughter to use an ISA so that she has flexibility and doesn't then impact the total value of pensions as well. So she can then say, okay, I want to stop at this time and I've got my ISA here that I can lean on or I can access anytime I like. So I think, if it was me, that's what I would do personally. What advice could I give my 17-year-old college students learning business? Long-term planning is usually lost on them. I wish I had an answer for you here that would help you, because you seem to be a lecturer and you really care about your students. and you're trying to help them, which I think is really admirable. Unfortunately, kids don't listen. And, when I was 17, I was a child and I wouldn't listen. I would just go in one ear, out the other, and I would think, I know more about the world than you, which is just stupid, isn't it? The thing is, like, what you probably got to say to them is, whatever I tell you, you're not going to listen. So go out there, make mistakes. Just make sure that those mistakes aren't too big that they completely fuck your life. And when you're ready to sort your shit out, come and speak to me. Because I think anything before then, they're just not going to take on. But if you're teaching a room of students, and there's lots of them there, I think if you can just impact one positively, then you've made a real meaningful difference to that person's life. So it shouldn't stop you talking about long-term benefits and things. And I think one thing that helps is talking about compounding and the magic of compounding, but talking about it in a way that maybe relates to them. Maybe you could talk about people in their world that they might idolize or that they're aware of. Someone like KSI, right? Who has basically started making FIFA videos and been consistent in content, and it's grown and grown and grown to a point that he might even be a billionaire now off bloody coconut water. So is there ways that you can bring the lessons that are timeless around investing and long-term thinking into their world to try and improve it and make it relatable? I guess that's the challenge of teaching. But yeah, I'm sorry I don't have a definite answer. In a way, I am a teacher. I sit here and I teach people, but I don't think, I have the answers to how to be a good teacher. I've got 300k in a SIPP. The Financial Services Compensation Scheme guarantees currently 85k. And if I understand correctly, potentially I'm at risk if my pension fund fails. Should I ideally have it in different banks to protect me from complications down the line? It could get very complicated. 430k would require 6 different banks. It would also require you to make sure that those banks didn't share licenses. So it's not individual bank, it's banking license. NatWest and RBS are part of the same license, as an example. So I think it's NatWest and RBS. It's been a long while since I've talked about that, so sorry if I'm wrong. What I would say is people focus very much on the Financial Services Compensation Scheme and that 85k of cover. They don't realise that's the last resort. That is the last line of defence if everything goes wrong. Your bank would have already had to have gone bust for you to claim on that. So yeah, it would have been bad. The thing that the Financial Services Compensation Scheme pay out for the most is bad financial advice from financial advisors. That's just because there's quite a lot of financial advisors versus banks that fail, right? The things that really protect you are the CAS rules, CASS. And these are the rules that segregate client funds. These are the rules around the deposits that banks need and the liquidity and things like this. These are the rules that I think are the biggest reassurance to individual investors that have really ramped up the amount of due diligence and oversight of these institutions since the 2008 financial crisis. And I think if we look at the 2008 crash as well as an example, if a major institution was to fail, like a bank, and it was taking people's pensions with them, I dare say that the government would probably bail them out. I mean, Silicon Valley Bank in the US got bailed out, didn't it? And, that was a mid-sized bank. One of the biggest ever banking collapse, the second biggest banking collapse in US history, but still a mid-sized bank. Most high street banks in the UK now are all considered too big to fail. If a Barclays went down, the domino effect would be global, right? So, I think there's layers of protection before the Financial Services Compensation Scheme. And I actually think the Financial Services Compensation Scheme in the main is there to protect people from bad financial advice from financial advisors and dodgy investment schemes. I think if you're with major global players and your funds are held with huge institutions, things like the CAS rules are really the protection that you should be looking at and getting reassurance from. Okay. I can only invest as little as £100 a month through a stocks and shares ISA. Should I stick to the S&P 500 or should I also consider investing in other stocks? That is completely up to you. What you do. If you want to invest in individual companies, go for it. What I would say is I would spend more time focusing on trying to get that £100 up than I would on picking individual companies. I think, it'd be a lot easier for you to, in your normal day-to-day life, to do some kind of extra work or improve your earning potential to double the amount that you put in than it would be to identify companies that are going to do well. I remortgaged my home and started a buy-to-let limited company after being slightly duped by some online courses, one of which cost a total of £32,000. It lost me quite a bit of money. I also invested 24k buying into a social housing scheme where I drove 7 hours and spent 5 days meeting the team and seeing their offices. It turned out they were buying houses and turning them into grow houses for Bob Marley prescriptions. Sorry, I laughed. Are there any due diligence skills I'm missing? How can I vet out and weed out the scammers? I'm sorry that you've had that experience. I do like the fact that you put weed out the scammers, though. I'm thinking that that's a nod to the Bob Marley prescription. So, very clever. Yeah, I'm sorry that you've had that experience. It tends to be more rife in property because there's a lack of regulation in property investment. I worked in that industry and it's just full of cowboys. There's loads of cowboys, loads of developments that don't get built and things like this. And there doesn't seem to be much protection for investors, which is a shame. I don't know why that's the case. So what I would say in terms of due diligence is it sounds like you did a lot. You drove there, you've met the people, what more can you do, right? I think people are attracted to certain property schemes because of the promise of returns. And these people are like, you'll double your money and all of this stuff. I would say anything that promises a high return is a red flag. And when I say a high return, anything above 7-8%, even if they're guaranteeing 7-8%, that's a red flag. Because anything that beats the market, the stock market, or is guaranteed to deliver, I would be really questioning hard. Because, if people have a guaranteed way of making 8, 9, 10, 12, 11, 13%, they ain't selling it. They're not giving it away. What they're doing is they're closing the door and hoping that no one finds out about their money printing machine. So yeah, again, I'm sorry that you've had that experience and I'm sorry that it's cost you so much money. I would say, take a step back now, stop looking at like property and these entrusting other people with your money and maybe make those decisions yourself. Start really simple with a buy-to-let property and gain some experience. Just buy a vanilla buy-to-let single family dwelling that you manage on your own yourself or through a quality agent in your area. Don't be giving your money to other people or handing over money for high ticket courses, because anyone who's selling you a course for 32k isn't making their money out of property. They're making their money out of selling those courses. If you need to get in touch with me and talk things through or let me have a look at stuff, just let me know. Like, you can email me or whatever. I'll get my mom, who's my PA, to pick it up and direct it to me, because I don't want you falling foul of these kinds of scams again. So if you see something that you're liking the look of and you're unsure, send it to me and I'll cast my eye over it and give you an opinion. I feel like I'm in limbo. I'm 40 years old and I have just enough money to either save for a decent later life or enjoy life now whilst I can, but not have much in the future. I think this is unfortunately the kind of conflict and decision that most people face nowadays. Should I live for today or should I invest? What I will say is that you will get older and there will be a time where you'll need money, and just carving a little bit away will relieve a lot of that pressure. So just please take a look at your budget and be honest with yourself. Is there areas where you could cut back slightly and just tuck even a little bit away? Again, also try and improve the income position. I know it's easier said than done, but can you move jobs? Is there something that you can do there to increase that income side? Sorry, I just ate a slice of pizza off camera and now I'm burping. Anyway, what are your thoughts on a 1 or 2 fund approach versus a more complex blended fund such as Vanguard's Life Strategy or BlackRock's MyMap? I don't mind the LS funds and the BlackRock ones. I think they're great for people that want to buy their kind of ready-made portfolio off the shelf. Again, whatever horse gets you to the destination. But I do think, with a little bit of research and a little bit of thinking, you could probably achieve what those funds look to achieve cheaper for yourself. And also, some of them have weird quirks. Like what put me off the Life Strategy funds in the end was the UK lean. I think they might have got rid of that now, or I'm not sure. But yeah, they were leaning more towards the UK because they thought that UK investors liked that. So those kind of quirks, I'm not as keen on. When I'm retired and drawing annual 50k lump sums from my Vanguard SIPP, will I still be able to contribute to my SIPP and benefit from tax relief on the contributions? Yes, you will, but you need to consider something called the Money Purchase Annual Allowance. I believe that's what it's called, the MPAA. So basically, once you start withdrawing money from your pension, you'll likely hit that allowance, and that reduces the amount that you can pay into your pension from then on. I think it reduces from £60,000 to £10,000. So there's a significant reduction. And what sometimes happens is people get access to their pensions at, say, 55. They start ripping money out because why not? But then they're like, oh crap, I was planning on working for another 10 years and I've significantly limited how much money I can pay into my pension now. So yeah, consider that. What happens to an ETF when a company drops out of the index, or if a previously top company becomes less important in the index? Think of the Premier League. I always think of the Premier League. So what happens is we have this, list of football teams, and every year some get relegated and taken out. They're replaced by ones coming up from lower leagues, and then, the position in the league changes constantly every time games are played. It's like this kind of moving around of the football clubs or the companies. So what we're talking about here is rebalancing, and you can think of the S&P 500 index as an example, as just like the Premier League. It's the top 500 companies in America, and who is top is going to change over time. So what will happen is there's this constant rebalancing of these indexes, and then the funds will look to replicate that rebalancing and shifting. And that can happen through the inflows, or when money goes in, they just direct it to different companies to adjust for how big those companies are now. Or there might be more extreme examples. So one example is Enron, who were a massive company in the S&P 500 who were just committing fraud. So when the fraud was found out, that company went bankrupt and they were removed from the index. And they actually, in 2001, replaced that Enron with a company that, is a pretty big deal nowadays, Nvidia. So that kind of thing can happen. Your index fund is looking to track the underlying performance or the performance of an index itself. And what they will do is they will mirror the transactions of that index. Rebalancing can happen daily, weekly, monthly, quarterly, whatever. But just think of it as like the Premier League. That it's that kind of process of the losers fall out and they're replaced by ones that are doing well below them, and the positions in the league can change over time. It tends to be the same big winners at the top, like the big six for a while, but that can change long term as well. And then every so often you get an Enron or a Man City like my team who get found out for cooking the books and get slammed into existence and, replaced by Preston North End or something. But anyway, what options do I have to avoid the issues that come with 100k annual earnings outside of just topping up my pension? So you can top up your pension, which is the best one, to reduce your overall income on paper so that you're taxed at a lower rate. You can give money to charity, tax efficient at that level. Or finally, you could look to use salary sacrifice to exchange money for certain things of value that your company might offer. Things like, healthcare or childcare vouchers, or a ride to work, a cycle to work kind of scheme. These are the three main things that you could do. Pension is probably the best. I have a 10k emergency fund and a total pension of 80k. Why do I still not feel financially secure? How do I stop the worry? Okay, I've been struggling with this. I always struggle with this. This idea that, I have more money now than I've ever had, but I still don't feel secure. And I think this is something that probably most people watching this can relate to. So there's a few ways that I've or the conversation that I have with myself whenever these thoughts come up in my head is I remind myself, first of all, that there was a version of me in the past that said to myself, if I had what I had now, I would be happy. So Damien 10 years ago, looking at Damien today, would sit there and go, Jesus Christ, I bet you're so happy right now. It's good to remind yourself that there was a point in time where you said if you had what you have today, you would be happy. Take stock of that and kind of like live in that sentiment of like, you said that this would be enough. Secondly, I think we have this tendency to catastrophize life and to think that everything's going to fall apart and that you're going to end up with zero, and that like somehow you're just going to end up butt naked in the street with everyone laughing at you with nothing to your name. Whereas the reality of the situation is every single year you found a way to just improve your life a little bit. Bumps along the way, sure, but you've always survived. You've always shrug them off. And you're here today, the kind of person that sits here and watches me talk about finance content for over an hour. Do we really think that you're going to end up with nothing? You're the kind of person that will consistently find a way to improve over time because that's what you've always done. I'm speaking to everyone here, but you specifically that asked the question. You got hundreds of thousands of pounds. In another 10 years, you're going to have hundreds of thousands more. So yeah, just remind yourself that in life, what tends to happen is what has already happened. So what I mean by that is, if you're the kind of person that's always found ways to earn more money, always found ways to be employed, always found ways to save and grow your wealth, well, I'm betting that trend will continue long term, and that there'll be a point one day where you'll have millions of pounds and you'll probably still be worried that it's not enough. So in that moment, then remind yourself of you today who said, I've got 80K, and if I had 2 million, I'd be happy. I don't have a better answer for you there because I think we all struggle with that. My auntie is quite a successful businesswoman. Well, no, sorry, quite a successful, she's in finance, she's a banker. She is a businesswoman, she's a boss. And I was telling her this feeling and she said, Damien, it never gets better. I never get to a point where I feel like I'm financially secure. And this one, she's retired. So yeah, I think we all struggle with that and we need to have a word with ourselves. But anyway, I love you all. Thank you so much for sitting here for an hour and listening to me talk. I'm on holiday for most of this month, so I just needed to make some content that was kind of easier to make so that I could get stuff out whilst also just taking my mind off the channel for the month and spending some time with my family and stuff. So yeah, answering all these questions I hope provides lots of value to as many people as possible, but it's also just taking the pressure off me in terms of producing content. So again, thank you for everyone who got involved. I'll leave a link to the newsletter below if you want to sign up to that. But yeah, have a lovely August. I'll see you in a couple of weeks as well, and I'll speak to you soon.